now admit all. Hang on. So let's just go to people and admit all. There we go. Good morning, Adrian. Good morning, Bryn.
Morning, everyone.
Morning.
Good morning, Chris. Good morning, everyone.
Morning.
If you've just joined, if you could mute, please, just to take out any background noise. It's usual. I can hear myself already. Guy, if you could mute. Thank you very much. That's good. That's good. That's good. Morning, Anna. Morning, Claire. Morning, Michael. Morning, Sam. Right. Okay. Anna, if I'm going to mute you, if that's all right, because there's a little bit of background. That's better.
Oh, no.
Oh, no. Sorry, Anna. I didn't mean to do that, but there you go. Right. Okay. Okay, Henry, it's 10:33, so we'll make a start. Good morning, everybody. Welcome to this week's Pension Playpen Coffee Morning. We are absolutely delighted to have Baroness Ros Altmann on today in conversation with our illustrious chairman, Henry Tapper. There's a lot that I think Ros would like to say. Rather than us attacking her, she can attack us maybe, or make some points and bring to the attention that we want to hear. There is an agenda and a number of questions that Henry will ask Ros, but wanted to say, number one, thank you much indeed in advance, Ros, for attending. Number two, we are recording, so is everybody happy that we're recording? So if the thumbs up, Chris and Bryn and everybody, thumbs up, we're recording. As usual, on Pension Playpen, we'll open the chat, and if you want to put any comments in the chat, please do. If there are any big issues that you'd like to point out or raise with Ros or Henry, please raise a hand. So without any further ado, I'll pass to Henry, who will take over proceedings. And thank you much indeed again, Ros, for attending.
Pleasure.
Okay. Ros, thanks very much for coming along. The last time we met was actually in the House of Lords, where you were hosting an excellent event where we were talking about investment companies and about the way in which they are struggling to get traction with the general public and other investors because of various issues that they have with disclosures. I don't think most people know very much about investment companies. Do you want to say a little bit about this?
Sure. First of all, good morning, everybody, and thank you for taking the time to listen to me this morning and for supporting Henry and Pension Playpen, and wishing everybody a happy new year. Let's hope it's a good one. As far as the specific question that Henry just asked me is concerned, this is something that has come to my attention in the last few months, really, and it's an issue that I have been grappling with in my mind for a long time, but I didn't realise that a real crisis has developed in the closed-ended listed investment company sector, which has got £250 billion and which has often seemed to me to be an obvious mechanism for pension funds to use as a kind of ready-made vehicle run by experts, investing in the very areas that pension funds have been looking to diversify into, such as alternative energy, infrastructure, real estate, and so on, illiquid investments, which are very much suited to the investment trust sector rather than open-ended funds like unit trusts, where daily pricing and asset values can often determine what an investor receives at the end of the day and can prevent managers from effectively managing an illiquid portfolio. So it has become clear that there is a regulatory failure in one of the, for me, most long-standing and ideal investment areas that consumers, whether they are retail or pension schemes, but particularly for me, some of the smaller pension schemes, and especially again for DC, could be using, which offer them this diversification. The regulator has rightly looked at increasing emphasis on the value for money that people get with their pensions and the charges that they pay. That's absolutely important, and I've always been in favour of transparency. But there's been some oversight when it comes to the listed closed-ended investment companies, which have built up portfolios that are managed expertly in real assets and some of these illiquids, which don't have the same characteristics as unit trusts or open-ended funds, but have been lumped together with them in a way that has ended up misleading investors and driving investors away from British infrastructure and alternative energy opportunities towards overseas companies or opportunities. This has been really damaging to British markets because investment companies are about a third of the FTSE 250. And it's been particularly damaging to sustainable growth prospects because the companies that are running some of the wind farms, solar farms, real estate and so on, life sciences, have been starved of capital, which means that we can't expand those areas that are so important for growth. And yes, there are several factors responsible for the last 2 or 3 years with the rise in interest rates and other elements. But the big homegrown, self-inflicted own goal that has undermined the potential for these types of funds, which are unique to the UK in many ways. Certainly the size of the sector is unique, and we have the longest experience and most specialist experience in many of these areas. They can't raise new capital. Some of them, because they've fallen to big discounts to their actual asset value, and the asset values have been rising nicely, but the share prices have lagged, taking away value from investors. They've had to buy back shares rather than investing in new wind farms or new solar farms or new areas. And what the regulator has done is forced companies to tell investors that they pay fees that they don't actually pay.
Sorry about that, Ros. Carry on.
So you've gone from a position where we wanted to make sure that no charges are hidden from the investor. So they're told properly about everything that they pay every year, every quarter, however it is collected from them, that they are that what they are charged to own this share or fund or unit trust. And that's right. We didn't want the hidden charges, but we've gone to the extreme that only in the UK, companies which aren't charging ongoing fees are forced to tell consumers misleadingly that they do. So what's happened is retail platforms have kicked off these investment companies on the basis that they look too expensive. DC default funds can't invest in them easily, if at all, because they suggest that there are charges involved in holding these schemes which are not charged to them, whereas the same kind of company operating without a UK listing and not regulated under these rules by the FCA show zero charges because the investment management cost is paid by the company, not the investor. And they are being able to be put into these portfolios. So what we're trying to do is help the regulator see that there is a market dysfunction, that the FCA is not fulfilling its obligations, that the industry is being let down and investors are being misled into steering away from what could and should be really important areas for a pension scheme to consider devoting money to. It's a massive own goal. And the irony of all of this is that we are not in the EU anymore. And the idea was to have our own rules that were suited to our own economy. And yet these EU-derived rules have been applied from 2018 in particular, way after Brexit, to uniquely disadvantage our own UK listed companies, while non-UK listed companies competing against ours are correctly revealing that the charges are borne by the company directly, not the investor directly. So the EU countries have not adopted these rules. They don't impose them on their closed-ended funds. And we need to urgently wake up to the risk that this is an existential threat and investors are steering away from these excellent investment opportunities, and or overseas companies are coming in and buying up some brilliant assets here on the cheap, and we will lose them. We will lose them to future growth. We will lose them potentially to our pension funds benefit, which could benefit from them.
Well, thank you very much for that excellent explanation of the problem. And I think you mentioned before that you're worried about how little our pension funds are investing in the UK. This is a sort of VFM problem for the taxpayer, isn't it?
Absolutely.
We're effectively incentivizing our pension schemes to invest abroad and disincentivizing them to invest in the UK. Is that a fair summation?
Certainly, as regards this particular sector, that is absolutely the case. But in general, there's nothing that is required of pension schemes to support the UK. Even the Mansion House reforms, which we may come back to later, which are encouraging pension schemes to invest in early stage unlisted companies, don't require any proportion of that investment to support the UK at all. So again, what is the government thinking here when we have this enormous pool of domestic institutional asset to which at least 25%, and I would argue it's more like 40%, of the value has been contributed by taxpayers, is used and diverted potentially away from the UK, when we clearly need increased domestic investment. We need increased support for infrastructure and sustainable growth. The government has made it one of its aims, and yet £70 billion a year worth of tax and national insurance relief for pensions can be 90%, 95%, even 100% invested outside the UK. And then the UK will still have to find billions of pounds in the face of a big fiscal deficit, post-COVID and all the other spending problems, to revive growth in a different manner or bring in money from abroad. I mean, overseas pension funds are supporting our economy sometimes more than we are, which does seem astonishing to me in terms of the opportunity that should present itself. We know that UK markets have sunk to a very low rating relative to other countries. That should represent an opportunity, but of course, if investors are not incentivized to put some of that money into the UK, then the temptation is when you're in an environment that the regulator says one of the most important things you need to do is look for low cost investment opportunities, the temptation is that you'll just have an index tracker approach where the UK is 3% or something of global markets. And that's what you devote to the UK in an international context. You know, the history of our success in pension schemes, and indeed the success of our financial markets, in my view, was born out of the vision of long-term pension investors, the sort of Ross type vision that drove pensions in the early days up to about 2000 or so, which said, look, if you want to be a successful investor, you've got to take some risks, but you would, in any normal capitalist system, expect to be rewarded for them. And because your members are going to be living and retiring mostly in the UK, you want to make sure that you support the UK market. And there is a quid pro quo argument as well, of course, nowadays, that with the huge amounts of money that are going in from taxpayers to build up pensions, at least a proportion of that money, maybe 25%, I don't know, one can come up with a figure, and I think we do need a debate on this, should be invested in the UK. If you don't want to invest 25% in the UK, fine, that's your choice. If you think the UK is going to be a dreadful investment or others are going to outperform stunningly, but you can do that without the taxpayer money, and that taxpayer money can be devoted to our country when we desperately need it anyway, and also when we know that there are opportunities here which are languishing. And that's where you come back to a perfect example of this being investment companies, which have been undermined by trends in the pension system, which haven't proved to be in the investor interest, that's for sure, and which haven't proved to be in the national interest either, and have infected the confidence in UK financial markets as a whole.
Do you have a solution which you're working on by any chance?
Yes, you know, whenever I try to point out a problem or an issue, it's always trying to be constructive. You know, there are ways forward that can address some of these issues. As far as the investment company sector is concerned, I think the urgency is to stop misleading investors about the charges that they pay. At the moment, both the regulator and parts of the industry are quite happy for unit trusts to be compared with closed-ended funds, which are not the same at all and which have very different characteristics, but compared on just the one yardstick, which is supposed costs of managing a portfolio of assets. The fact that investors are led to believe that that is a like-for-like comparison, which happens in all the retail platforms and all the international comparison charge tables, is something that could be changed rapidly. If you want a legislative solution, then taking investment companies that are closed-ended, that are listed, out of this misleading disclosure regime, which has come from EU rules such as PRIPS and MIFID, is an obvious way. You need, of course, to disclose what is charged for the investor to manage the portfolio, just like any investor in a listed company needs to know how much the management get paid, what directors' bonuses are, what non-execs get paid. All of those things need to be revealed. But you wouldn't dream of telling an investor that they should consider the cost of management bonuses and director fees and legal fees and accountancy fees for every share that they buy and compare that to whether it's better to invest in a unit trust. You look into the accounts, it's all discounted and taken account of in the market share price. And of course, you don't want investment trusts to be charging extortionate management fees. As it happens, they don't. They have boards that are very conscious of cost. But if that were to be the case, then the market share price would reflect that. But to say that you shouldn't invest in an investment company because it charges 1.5% or 1% or 0.75%, whatever it is, to manage a portfolio of real assets, when a unit trust, which, no unit trust has this exposure to the illiquid assets that investment companies will give you, by the way, in renewables and so on, and to compare it just with a unit trust, which may focus on some of these areas, even if not exclusively, is misleading the investor and cannot be in their interests. And for retail platforms to kick them off, so then investors can't even consider buying them or selling them if they've already got them, does seem to me to be suboptimal. And the other quicker way would be for the FCA to announce that it believes, as is clearly the case, and as the industry itself now has confirmed, that the in which these investment company charges investors or lead investors to believe are made is misleading, is in contravention of the Consumer Duty, which requires any information given to consumers to be clear, fair, and not misleading, and which is also damaging the integrity of UK financial markets, and is also damaging potentially sustainable growth, and is definitely harming international competitiveness of UK firms. All of those are objectives set by Parliament for the FCA to meet, which it is failing in this regard. The FCA could stand up and say, we've recognised there's a problem, we're working on it, which we know that is the case, but any solution seems to be months or more away. From now, we will clarify that we believe these charge disclosures are misleading and therefore are not in the investor interest and need to end. So the other part of this, by the way, is that there are some listed investment companies which are not following the rules in the UK anyway. They are UK listed companies, big firms, Legal & General, perhaps even BlackRock, which have decided that these rules make no sense, which we know they don't, and they're therefore not calling these charges ongoing investor fees, because they're not ongoing investor fees. But those small or medium-sized companies, which don't have the luxury of being able to do that, are therefore being damaged both domestically and internationally by unfair competition that is driving investors away, in the face, particularly as regards pension schemes, of things like DC charge caps.
It's very interesting that you mentioned this question of comparators. You've got big companies who are unilaterally going it alone and doing it their way, smaller organisations remaining compliant. There is, of course, also the very interesting debate going on about just what kind of structures should be used by these large pension funds. I mean, DC funds now nest over 20 billion. People's getting there. LifeSight not far away. We're talking about organisations that are still primarily invested in insured funds. And the government's strong proposal was that we would get stuck into illiquids through LTAFs. I see you smile. Just interesting to know why you think there is such a strong push towards using insured pooled funds, investing in an open-ended way rather than a closed-ended way, typically on insurance platforms using permitted links? Why is there's such a strong bias, do you think, in the way in which we do things?
I wish I knew. It makes no sense to me. There are so many problems with trying to use an open-ended structure for a DC pension scheme. The LTAFs are, as you say, going to be open-ended. Yes, you may have some lockups and things, but the closed-ended structure is certainly what I would say needs to be a significant part of the mix for a DC pension scheme in an ideal scenario. Because, first of all, open-ended funds are not suited to illiquids. Look at some of the property unit trusts that we've had. You know, that if an investor or a group of big investors want suddenly to sell, the manager is forced into liquidating quickly its assets or into gating the fund. Now, for a pension scheme, if you want to sell or need to change your asset allocation and have a different type of investment, then a closed-ended structure allows you to operate on a market price. Much different from the open-ended structure. Now, that's not to say that you wouldn't have to take a discount, but that's your choice. In terms of an open-ended structure, if people are pulling out, the investors left behind don't have any choice about assets that will have to be liquidated at knockdown prices to raise the cash to repay. So there is a danger for me in this arena. I think the opportunity to game the LTAFs is quite significant too. If you see a market fall and you want to get out at the current price, there's a risk with an open-ended fund. Long-term investor funds, which are invested in these kind of long-term assets that are meant to deliver a return stream over a long period of time, are ideally suited to closed-ended funds. And what's even more frustrating for me is that we already have, billions and billions of pounds of specialist investor money invested here, and teams of experts who have built up real asset portfolios. The whole closed-ended company sector has changed. It originated as basically diversified pool of equity, listed equities, big cap stocks, or active management selection.
We've got a question that's come in, Ros, from Porrig. I don't know if you want to ask that yourself, Porrig, or whether you'd like me to read it out. If I hear no answer, I will read it out.
I'm happy to read it out.
Yeah. Okay.
Henry. Yeah. Good morning, Ros. Lovely to see you. Look, I've got a problem, a major problem. It's a kind of structural problem, and it always comes back to this. But how can you expect any change when the FCA is at best reactive and worst supine? It develops regulation at a positively glacial rate, each step protecting its backside seeming to be more important than taking a strong and proactive role. It took a decade. This is one thing that really makes me angry. It took them a decade to realise financial services entities had a consumer duty to their customers.
Yes.
And that's just laughable. I mean, it's frankly laughable. It should be criminal, right? And it's just not fit for purpose when it comes to protection of consumers. I mean, it needs to rocket up its arse to get anything done. So how can you expect it to actually take hold of this situation and drag itself and the industry into the 21st century and this new situation? It really needs to be rethought. Sorry,
Well,
there you go.
Porrig, it's lovely to hear from you, and I couldn't agree with you more on this particular issue. It's a classic example. Parliamentarians Baroness Bowles, John Barron, I mean, really, you know, powerful people. And myself, who's been tagging along, if you like, have been desperately trying to get the FCA to understand what an urgent crisis has been created, albeit inadvertently and perhaps, you know, for well-meaning reasons. But the kind of box-ticking supposed consumer protection has gone the other way. They know about it. They keep telling us they've been working on it, but nothing has meaningfully changed. They put out some statement a few weeks ago which said, okay, we realise that maybe there's a problem with the misleading charges. So you still need to report those charges misleadingly, but we will allow you to have some kind of footnote or something. But that's not how the market works. And the problem we have, and why I hope that we might have some hope of a quicker resolution, is that ministers need to get involved. Treasury ministers can point out to the FCA, shall we say, that there is an urgent problem that is in breach of their principles, in breach of their remit, which this, in my view, clearly is. And in fact, last week, there was a consultation on the first regulatory change that is meant to deal with this, where unprecedentedly, more than 300 people signed a joint industry submission to the Treasury to say, we need this to change urgently, and this has got to come out in a different way as quickly as possible. The FCA keeps saying, oh, but you know, we can't do anything because it's in legislation. But actually, they're turning a blind eye to those who are breaking the law already. And they could issue guidance that would help to redress this problem. So what we're hoping is that there will be legislative change, which we know takes quite a while. But on top of that, there will also be FCA clear guidance that the current system on this particular issue is misleading consumers and cannot be said to be in the consumer interest. But I share your concern that, you know, stable doors and
Yes,
horses
I
long
know, I know
gone.
you do. I know you do, and I know you're not inactive on this in this area, but they're very good at waving sticks, wringing hands, and dragging feet. But when it comes to their prime, you know, discharging their prime duty, they seem to be very slow and ineffective. So,
I have a real concern that many at the FCA don't really know how the markets work. And I must admit, I didn't know all the intricacies of all of this until I was looking into it, and Baroness Bowles alerted me to what was happening. And then by the time I had kind of got into the detail, it was staring you in the face that this was a real terrible problem and homegrown, totally self-inflicted. And I just assumed that the FCA would urgently look to remedy it. But their sense of urgency seems to stretch a lot longer than mine or anyone in the markets might.
We've had an interesting suggestion from Anna Tilburg. We have a new TV programme. I think it's going to be called Mrs. Altmann Against the FCA.
I don't want to be against the FCA.
It's going to be a 4-part mini-series. Thank you, Anna.
I want to work with them. You know, we are trying.
You couldn't have summarised it more, Henry. Yes.
Okay.
A new ITV drama. Yes. Sorry.
Carry on. We've also had an interesting comment from Derek Scott, who I know has been very involved over the years in the Financial Reporting Council. Do you want to sort of say what you had to say, Derek, or would you like me to ask the question for you? I think the point that Derek was raising was that actually insurance companies have been very favoured, and it wasn't until 2019, if you look at the chat, that the VAT advantages given to the insurance companies were taken away. There seems to have been a long history of preferential treatment for insurance companies in fund management when it comes to pension funds. And I hope I've got the gist of what you were trying to say, Derek. Okay. Billy's been in touch, as he always is, asking, and I know we've had Al Rush on this call as well, and I suspect he'd probably be asking the same question. But do you want to speak, Billy?
Oh, thank you, Ros. I mean, you know that I'm sort of passionate about advice, and I don't want to, distract from what you're saying about investments. But I'd be interested in your view on what's happening with this so-called advice gap. And Patrick's quite right. The FCA move very slowly, and from my point of view, advising clients still, it's getting harder and harder, but the regulations are getting more and more, and advice is just going to be for the so-called fat cats. And what about the so-called Middle Britain people and the post office workers?
Well, I have to agree with you, Billy. The big sadness for me happened around pension freedoms when I think this was a brilliant policy decision. I know others may disagree with me, but I happen to think this was right. But the whole thrust and purpose of no longer requiring people just to buy an insurance company annuity was so that they could make properly informed decisions that might be suitable for themselves. And the idea of PensionWise, which was announced absolutely alongside it, was meant to be the lead-in advice for those who have had guidance, independent, impartial, not from your own pension provider's helpline, who will obviously try and steer you into whatever products they want to sell you and may not tell you about clearly about other things. So that the guidance was meant to be showing people these are not easy decisions. There are complex questions to consider and ask and answer, and there are timing issues and all kinds of risk factors that you should consider. And therefore, if everybody who was thinking about what to do with their pension did get kind of impartial guidance to help them ask the right questions, many of them would then say, well, hang on, I realise why I might need an advisor. The guidance was set up originally from age 55. Now, as minister, one of the very few things I managed to achieve was to get the PensionWise minimum age down to 50, which again was the vision that you want to talk to people about what to do with their pension fund before they can take money out, so that they realise why they shouldn't. Because the best thing for most people to do with their pension pot is probably to leave it alone at age 55 if they're not very ill or retiring or have got other pensions. But nobody necessarily says that to them. By the time they reach 55 and they can do it, the temptation's too great. So at 50, it seemed to me, and I worked very closely with Harriet Baldwin at the Treasury, we were of like mind, and we got that change down to 50, but still not enough people ever got the guidance, and they still don't. So the outlook for advice is not as positive as it otherwise could and should have been. And I can't tell you where we're going next, because the FCA, I don't think, is clear in its own mind.
Yeah, thanks.
Yeah, I've just heard the big news that's come in on the waves, which is for the French insurance company has bought Elstree Film Studios, and with it the set of EastEnders. Can you imagine a bigger insult, yeah, for having these AXA, yeah, owning the EastEnders set, a cause célèbre, if ever there was one, Baroness, for you to thump a little bit further and say, let's get these assets into our pension funds and not into the hands of the filthy French. Sorry, any filthy French on the call.
I don't think the French are filthy. I'm sorry, Henry. I have to disagree with you on that. But I do think that we should have our choice assets owned domestically. And there is a huge need and opportunity for our pension schemes to support our country and our economy. And that opportunity, every week that goes by, is being missed.
Yeah, okay. Apologies there for that flagrant xenophobia, which came from Middle England, and I regret saying it now.
I'm not sure Middle England also would fully agree, but maybe I'm wrong.
But we do love our EastEnders, don't we? Okay. My final question, and if I may, I'll move on to that. You know, you touched upon the work that you're doing with Baroness Sharon Bowles and others. And we've got Bryn on the call as well. It seems to me there's a lot of expertise in the House of Lords, in the upper house, and it seems to be punching above its weight at the moment on pensions matters. Do you feel that the system is actually working well, or is this simply an example of how poor pensions is represented in the other place?
Well, Bryn can share his own perspective, I hope, but from my perspective, there is a kind of core group of pension peers. I don't think we've got an official name at the moment. You know, long-standing experts like Bryn, like Jeannie Drake and Maeve Sherlock, and then people on all sides of the house who will regularly talk to the regulators together as a cross-party group, who often will meet to discuss forthcoming legislation or support each other. You know, we may not always agree with each other, but I think very often we do. And the best work that the House of Lords tends to do, in my experience, is when cross-party groups get together and, independent of political party loyalties, if you like, work on what's best for policy, what is believed to be in the interests of better policy. Very often you will find that legislation comes in which is drafted in ways that might have unforeseen consequences, or in practice in the markets might not work as well, or it may feel as if they've been driven by particular vested interests. That goes back to sometimes the insurance company view prevailing over other views, which may or may not be a good thing. And that's, you know, the Lords is meant to be an independent scrutiny chamber to some degree. Bryn, do you want to say what you think here? Because we know we have had some successes.
Yes, I think the question was also about the Commons. I think the problem, there's some really good people in the Commons, but they don't get the opportunity. The system just works against them in ways that that it doesn't for us. I think it's worth saying that it's a relatively small group of people who are have got a pensions focus.
Yes.
I wouldn't want to exaggerate the number, but we are listened to. I think as a house, people listen to people with expertise, and I think that has been established. What impact we have on the development of policy is a slightly, well, no, a big different issue. But I think there's a sort of team of people in the Lords. I think there could be a team of people in the Commons, but the way business is conducted there is so different, and the pressures on MPs are so different. It makes it very difficult for people to be as focused as perhaps we are.
Which is, by the way, why I think there is so much merit and importance in having a second chamber that isn't fully elected. You know, to have these experts here who don't have to trot behind the whip every time if they feel that there is something seriously wrong in an entrenched position, has real merit. And I don't think the public often appreciate fully how much time the Lords spends trying to get things right, and very often having to stand up against maybe entrenched political positions sometimes as well, but is willing to do so. If you were a wholly elected house, it would be harder to be able to do that.
Yeah.
One thing I'd add is, sorry, Brent, carry on.
Well, I am impressed as a relatively new entrant at how well the Lords works. It's totally undemocratic. I'm personally committed to its abolition and replacement with something with more democracy, but it's difficult to see how it would actually work any better.
It's a very interesting observation.
All the criticism of the Lords is about its structure and where the people come from and how much champagne they drink. You see very little criticism of the input of the Lords to the legislative process.
I've never drunk any champagne in the Lords yet. No,
there was a story in one of the papers recently.
368 million bottles drunk last year or something, Ros.
Yes,
I think
not one by me. So.
Not one by you. I'd like to think that the tea room remains the tea room, but I think the bishops have got their own little place where they have a tipple around the corner, and everyone seems to have their own private bar in your shop.
The bishop's bar is open to everybody. And we usually have tea or coffee.
Okay, well, it's good to know there's some sobriety.
So I don't want to come in the lot.
No, I don't want to bring the house into a discussion. I'd also like to say something for the Work and Pensions Committee, which I think does a good job of scrutiny. Yeah. I think we have in Stephen Timms a real national treasure. And if you get a chance, guys, to watch some of the catch-up TV of the work and pension stuff, some of the most excellent pension debate we get. Certainly a lot better than some of the crummy conferences I've attended over the years. So yeah, I mean, there is a lot coming out of Parliament, which is really, really good.
The Treasury Select Committee is doing some good work on the investment side, and the Economic Affairs Committee in the Lords has also done some excellent work.
And your regulatory group as well in the Lords, I think is good. So I know we got some regulatory experts here, like the aforesaid Anna Tilber and so on, who'll back me up on this. But you know, we are grateful for the work that's being done. It is underreported. I'm always pleased to see that Joe Cumbo and others do report it in the mainstream press, and my blog will continue to what you guys are doing. So please don't think that we don't notice. We do. I'm conscious of the fact that we've got a few minutes left on this excellent pod. It's not a podcast at all, is it? It's web chat, I think.
We've got a couple of questions.
And we've got some questions coming in. Yeah. Down the bottom here, Philip. Yeah. I've only just joined the quantum. What's Ros's view on the proposals that mandate schemes to provide a default retirement solution? Ros.
Well, a default anything really troubles me. I think, you know, the default pension accumulation products have proved to be, in my view, so flawed. And I must admit, I wrote a report, I was just reading it the other day, straight after the pension freedoms were announced, which sort of assumed that lifestyle and target date funds had reached the end of the road, because with pension freedoms, you couldn't assume that somebody was going to buy an annuity at a particular date, or even take any money out of their pension scheme at a particular date. So the long-term investment theory should override the drive that these funds would push people into, to just give up on investment returns and move into supposedly low risk investments, in which unfortunately many of those coming up for retirement lost 20 to 30% of their money without any warning, believing they were in very safe investments. So any default fund which tries to suggest that a pension is a one-size-fits-all product worries me. If there were to be any default at retirement, in my view, it would be, you don't take the money out, leave it invested until you want to make a decision as to what to do with that money. To be put automatically into something different from the accumulation of investment returns and investment growth in a product that's meant to last a lifetime, not just to age 55 or 60 or even 65 or whatever, would trouble me. But that seems to be where the regulator is looking. And why would you need to change from accumulation to decumulation at any predetermined date? I don't quite understand it. If you wanted a default drawdown type product, once somebody's made the decision, I would much rather go with the 4% of whatever your assets are each year. And if your assets have gone down, then next year you have slightly less. If your assets have gone up, next year you have slightly more. That type of approach, very simple. Keep it simple, stupid is always the motto that I would like to follow. In KISS pensions is much more preferable, in my view, to the industry saying we know best what people would choose if they were to choose, but they're too ill-informed or lazy or uninterested or unengaged, disengaged, maybe that's the word, to actually do anything. So we're going to do it for them. I just don't think that's a responsible or reasonable approach to take anymore. It's the old-fashioned way, when anybody was in a pension scheme. Don't worry your little heads about it. We, the clever people in the industry, will decide what's best for you, and you can just sort of trot along and know that your money's going to be doing fine. Well, actually, the so-called default funds in DC didn't leave people doing fine. They really didn't. Now, that's not to say that that's a normal occurrence. Of course not. This was a very unusual period. But even so, there are people who were seriously disadvantaged in ways that they were never led to expect.
I've got another question that's come in. I've got two more questions. Philip, does that answer basically give you a proper answer of Ros's position to your question about drawdown? I suspect it does. I mean, there. There's a roaring silence on the other side, but thank you for the questions, Philip. And Anna, do you want to come off mute and just ask your question of Ros?
Hi, Ros. It's always great to hear your thoughts on the industry, and I'm a fan. So my practical always, what can I do when it comes to evidence-based academic papers? Usually, the problem with our research is that it lags behind about 2-3 years by the time to publish a peer-reviewed paper. But actually, now there's an increasing rise of practical of policy research that is being recognized as academically robust. So is there any, in your view, what can we do as a field to kind of back you up and produce kind of papers or whatever? So basically I'm available.
Oh, thank you.
To channel your ideas into some really
ideas,
channel your ideas, Ros, into rigorous based research.
That would be
yeah.
be brilliant, and it's nice to have a fan. The main thing would be to focus on the, one of the areas could be to focus on the default fund and what the outcomes have ended up being, and the range of alternative options that might be presented, comparing the costs of drawdown in the complex types of approaches relative to a simple one. And again, looking at historic numbers, it's very difficult to predict. An analysis of what types of pension those who've taken only cash have. This is something that the industry should be asking anytime someone withdraws their pension scheme fully. If they've got another DB pension somewhere else, or other big DC pension somewhere else, that's not a worry. If that's all they've got, that is potentially of some concern. But we don't know that. We really don't know what the position has been in lived experience since the pension freedoms. And I think we could learn a lot from understanding that. And then, why is pension-wise so poorly taken up? Those types of questions.
Thank you.
I'll think about it if there's anything else, but
I would totally reiterate what Ros is saying there. I think there is so little evidence base for what people are actually doing at retirement, and so much speculation, and it worries me. Steve Goddard, now, goodness me. Steve, you've got your hand up. What have you got to say for yourself, young man?
Yeah, just a small point on that issue that Ros was talking about with small pots or the under 30,000 cashing out. In the last few years, we've seen a massive change in annuity rates, and it's very sad actually that some of the members have probably cashed out when now they could be getting crazy rates of 6, 7, 8% on conversion on income. And when you think about it, that's worth a lot of money long term. 5 or 10 years ago, sure, your annuity rate was 2%, 2.5%. But now if it's 6, 7, 8% and they're cashing out, surely should the industry not be warning people to at least look at it more closely?
Well, again, that if people went to pension-wise, that would be absolutely part of the conversation, a very important part, which they could then say, well, I'm happy to make my own decision, or I might want some specialist expert advice to help me make that decision. Unfortunately, the choice of buying an annuity is not a simple one. If you're going to be taxed on the money, it's a different proposition from if you can take money out. If you've got 10 grand pension, take it out tax-free. There are lots of moving parts, unfortunately, to our pension system, which mean, it's not simple. It could be that people need much more hand-holding. But what type of annuity should you take? What kind of health are you in? What other calls on your money do you have? All those are vital for people to consider, not just the annuity rate, or the supposedly headline single life level annuity rate. Do you have any inflation protection other than the state pension? Those types of things are not simple, but you can express them and discuss them with ordinary people in language that they will understand. And that's what hopefully independent guidance can do. And then once these things have been explained in ordinary language, not the jargon, do you want annuity or drawdown? Well, most people in any pension fund wouldn't have a clue what you were talking about unless they had done it before or discussed it with someone else. We need to discuss in simple language what we're talking about. and also the do nothing option that
Right.
could have many merits.
I'm really sorry that we're going to have to do something, and that's close this meeting down because we come to the end of our hour, and because I have to rush up to London. I have to say goodbye. But I mean, it's been a brilliant hour. It's been an hour where we've all engaged in some really intractable problems, from investment companies, disclosures on one side, to the nature of retirement decision making on the other, with bits in between about. Thank you very much for the contributions of Anna. Thank you for the marvellous rant from Porrick. And thank you for the little bits and pieces from Phil and others, which has made this such an entertaining meeting. Thank you too to Derek for his question, and of course to Billy. But most of all, thank you to the Baroness and for Bryn, because we really do appreciate you guys and what you're doing. And it's great that you turn up on a web call on a Tuesday morning, as you have done. We're really grateful, and I can say that because I know that, you know, well, we ain't paid you a penny, and you've just given of your time freely, Ros. So thank you very much, and a big round of applause from everyone.
Yes, well done, Ros. Absolutely.
Well done to Plench and Playpen. And Jim, if you want to message me privately with your question, I'm happy to answer. I think we did everything, everyone else, I think.
Oh, I'm sorry we missed your question, Jim. That's my fault. Yeah.
Yeah. The video will be up this afternoon on the website. We'll obviously redact the version without Henry's comment regarding the French. And obviously Henry. We'll edit that out, Henry. And obviously you don't like champagne either, Henry, because that's French as well, isn't it? So there you go. Yeah, so you know, we'll next week we have the amazing Sarah Smart from the pensions regulator, and that should be an interesting discussion with the regulator. So thanks for joining today. I hope everybody's safe and well. Let's pray for peace in the East and peace in the Middle East. And we really, really appreciate Baroness's time. So thanks very much, everybody. Enjoy the rest of your day. Thanks very much.
Cheers, everyone.
Bye. Bye.